Today is Sunday, September 20th, and this is a market review for Friday's stock market activities and outlook for this upcoming week. We have important discussions in the agenda today, specifically in the options market. We will talk about some trades that I have found that are really interesting and could indicate what's about to happen in the stock market. And of course, we have a lot of interesting headlines following up on the TikTok saga and some Fed personalities making stupid statements. And of course, the charts today will be very interesting. We have the Qs, the SPY, the short triple Qs, Tesla, Apple, the VIX, the dollar. So buckle up your seatbelts and let's go. And here we go. The Dow Industrial Average closing in the red, a decline of 244.56 points or 0.88%. The Nasdaq down 116.99 points. Let's round that up to 117, and that will give you about 1.07% decline. The S&P 500 in the red, 37.54 points or 1.12%. And here is the sector's performance. Pathetic performance by all sectors. We're not giving any medals for such performance. Healthcare managed to close in the green just by a hair, but you see the rest of the sectors closing in the red. However, I want you to pay attention to the performance of basic materials. Here is the weekly performance of basic materials coming at number 4, and here is the 1 month performance of basic materials. You see that they're coming at number 1. Here is the 3 months performance of basic materials, leading the pack again. And finally, here is the half-year sector's performance, and as you can see, basic materials in the lead again. These are all very important indicators for the overall picture of the business cycle. Where are we in the business cycle? And here is a typical breakdown. You can see the basic materials tend to outperform the overall market during the late stage of the run. While everybody was popping the champagne and betting on technology stocks as if they were betting on horses, basic materials been leading a silent rally from behind. And if you were paying attention, basic materials told you that we are in a late cycle and we were headed for a big correction and perhaps a bear market for years to come. And now switching to the futures market performance. And of course, we had a headline of the Trump administration allocating an additional $13 billion in farmers' aid. So we're basically becoming a socialist state that gives handouts to farmers instead of making trade deals and infrastructure deals that help farmers make their own money and prosper their own businesses. That aside, you can see the outperformance of grains. It's been happening for weeks now. Soybeans, corn, oats. And that is of course due to the surge of Chinese buying and purchasing of grains from US farmers, in addition to lean hogs, of course. So on one hand, you're hearing about the TikTok back and forth and all the rhetoric against China from the Trump administration. But when you dig down into the futures market, they're kind of helping him by upping their purchases from farmers in the Midwest. Again, this could be a facade behind the scenes, or it could be just that China needs more stuff, but it is certainly interesting to look at. Other futures that managed to close in the green and make significant gains. Coca and metals, of course, specifically copper. Copper continues to outperform, and the long-term picture for copper is very, very bullish. This is why I am investing in copper. And the notable decliners of the day, of course, lumber had the dead cat bounce and continues to trend lower from here. Coffee still trying to find where the bottom is. We will see a rebound in coffee, but we need to see coffee finding a footing first. And moving on to the options market, the big casino. Per usual, Apple and Tesla leading the day. Apple with 3 million options traded on Friday. 58% of those were calls. Tesla, 1.5 million options traded on Friday. 65% of those were calls. And here, of course, we have an interesting name, Vale. This is a Brazilian company, mining company. with about 707,000 options traded on Friday. 92% of those were calls, and that solidified the argument that basic materials will outperform significantly. They've been outperforming, they will continue to outperform in the current market conditions. At least this is what options traders are telling me. And of course, speaking of basic materials, let's go to one unusual trade that I found in the options market on Friday. It is for Freeport-McMoRan FCX. This is a stock that I've been investing in for a while. I announced way back that I'm buying the stock when it was priced at about 11 to 12 bucks. And you see, of course, Freeport-McMoRan managed to outperform the market significantly, and it was my best performer in my portfolio the last few months. And here is a bullish trade, of course. For October, you see the surge of volume in compared to the open interest. So traders are betting for a big, massive move in FCX. At least this is what this one bet tells me. Now, what I see is quite different. I see that the long-term picture of FCX is very bullish. However, when I saw this trade and when I see the mania and people rushing to buy this name right now, when it wasn't popular a few months ago, I am actually buying puts in my position, betting on a decline for FCX in the short term before dip buyers will buy it and march it higher. And of course, when I look at the chart, I see that the RSI is very extended and it's due for a correction. This is from a weekly perspective, of course. So what I did instead is buying puts against my long position in Freeport-McMoRan. And of course, if my thesis come true and I make money from these puts, I will use the proceeds to increase my position in the name. And of course, here's another interesting trade that I found for Hilton. I found another one for Marriott, but I couldn't find it when I was recording this video. But it doesn't matter, it is the same trade, Hilton or Marriott. And the bet here says that we will see a 10% decline in the hotel names, specifically Hilton and Marriott. I do agree, specifically when you see the cases of COVID surging in Europe and you see the AstraZeneca trial performing poorly, where we have a second patient sick now and the trial did not resume in the United States, meaning we will see a lot of pain coming in the comeback stocks, airlines, casinos, cruises, lots of the consumer goods names. And as you know, of course, I am investing in some of these names, specifically Marriott. Granted, it is a very small position, but I still bought puts betting on a 10% decline in the next 30 days. And of course, when we get closer to the expiration of the puts, I will revisit and see if we saw a rebound in these names and a recovery, perhaps the announcement of a vaccine. I will exercise the puts and add to my shares in Marriott. But it is very interesting trade, and you can see that option traders are betting and seeing things ahead of time, and they're betting on a decline in the hotel names. And now moving on to the headlines that shaped the day. In the first headline, of course, the TikTok saga. First, we've heard that the Trump administration will ban the downloads of TikTok and WeChat starting today, Sunday. And that certainly could have scared the market, that the rhetoric between US and China will escalate and US technology companies will be the collateral damage of this escalation. And of course, it didn't take long for us to hear from China. China saying that they will take quote-unquote necessary measures to protect Chinese firms. And over the weekend, of course, things got a little muddier, with Trump asking TikTok or the TikTok deal to provide $5 billion to the US government to start history education fund. How about we let TikTok pay our national debt or pay for our infrastructure projects instead? This is getting insane. And of course, the last thing we've heard right now is that the ban on downloading TikTok has been delayed for 1 week. So the saga continues and it will get hotter and hotter. Moving on to some news from the Fed. Federal Reserve Minnesota President Neil Kashkari. If you're not familiar with Neil is a very interesting character because he's on Twitter. He's bitching and moaning every day about people bullying him and trolling him. Neil came out on Friday and he said that any narrative that inflation would run over and get out of control, it's just ghost stories. Neil, I remember the ghost stories from the 1970s. when inflation got out of hand and the Federal Reserve had to take the nuclear option of destroying the economy to save it. But Neil is one of those guys who have a mental lag or a mental delay where he figures things 3-4 months, sometimes later. And case in point, of course, his comments about the pandemic bailout. Neil figured out on Friday that the pandemic bailout was another bank bailout in essence. We've been saying that since the bailout started, since the PPP loan started. But Neil, now that we are over 6 months now, has figured out that, wow, the PPP loan was just another bank bailout. Oh my God. And of course, the PPP loan scam saved the banks. The banks' earnings, and we reviewed them in details, were miserable. However, they made a ton of money from processing the PPP loans. The PPP loans, in essence, if you are a small business owner, you're getting your money back from the government. Why the hell do banks get to charge fees for processing our own money back? But Neil, of course, didn't figure this out when he supported the PPP loan program facilitating via commercial banks. He figured it out now, 6 months later. And I don't know what kind of meth Neil has been doing lately, but certainly not the streets meth. This is the good shit, the Federal Reserve meth. Some of the side effects of the Federal Reserve meth, of course, is it causes mental delays. If you run into Neil these days, he will approach you and say, oh my God, did you see that Super Bowl the other day? The Pats made that comeback and they beat the Falcons. Oh my God. And he'll be like, Neil, this was like 3 years ago. And he'll just stare at you with those doe eyes of his. And of course, speaking of his eyes, Neil looks like he's been doing the TikTok try not to blink challenge. The only difference is that he didn't get the memo and he's been doing it permanently. Like, hey Neil, wake up, wake up. You're supposed to do it for a few seconds for the fun of the TikTok video and then you're allowed to blink. But of course, it's gonna take about 3 to 4, maybe 5 months for Neil to get the memo. And moving on to another Fed clown, this time it is Jim Bullard. We talked about Jim Bullard in a separate video. Bullard been doing a significant amount of hash lately, and now he's hallucinating and he's seeing that this GDP, the third quarter GDP, will be one of the best ever GDPs that we've ever seen. Of course, Bullard is forgetting that this is gonna be a rebound, a dead cat bounce in the GDP, which is expected to be significant given the drop that we've experienced in the second quarter. However, Bullard is becoming very pornographic in his predictions. He's saying that the GDP growth will exceed 35% in the third quarter. Meanwhile, his own organization, the Federal Reserve, disagrees, and they actually downgraded the outlook for the third quarter GDP. It doesn't matter to Bullard. He's riding the high cloud. Speaking of the high cloud, here we go. We had some good news, and I say that sarcastically. Consumer sentiment is reaching 6-month high. The kitchen was pretty good on Friday.
Oh, that's the flavor.
I felt he used too many onions, but it was still a very good sauce.
Vinny, don't put too many onions in the sauce.
I didn't put too much onions.
Because, of course, if you see the real data that half of U.S. households spent their stimulus money in buying food and paying their outstanding bills. How does that rhyme with a high consumer sentiment? Maybe they've interviewed a bunch of people in the Hamptons for this survey. Moving on to a check on the market mania. Barclays and many other analysts, quote unquote, right now, are finally comparing what's going on in the market with the bubble of 1999. Of course, a few weeks ago, they've been upgrading their targets in Apple and Tesla and Nvidia, and now all of a sudden, they're gonna start downgrading because this is what analysts do. It's a bullshit job. You just follow whatever the stock did. You pick a number out of a hat, and you upgrade and downgrade. And of course, the SEC continues to keep a blind eye on this corruption and this circus of analysts upgrading and downgrading on a whim. And of course, continuing in the mania, here is a piece that outlays something very significant. We've seen the SPAC mania, and now no revenue, doesn't matter, no problem. Morons and Robinhoodians will continue to buy your stocks, even without revenue. Case in point, Nikula. We have seen this exactly in 1999 and 2000, where companies that had no offices, no employees in certain cases, and no revenue, and the IPO will surge 80, 90%, and we all know how that ended. And now let's move on to the heat map analysis. From a daily perspective, as you can see, it is a sea of red with very few shining sectors and boxes, mainly in the healthcare sector. However, when we switch to a weekly look, the big picture in the heat map, we can see the outperformance of late cycle sectors such as basic materials, healthcare, industrials, some of the consumer good companies, some utilities, and you can see that, of course, clearer when we shift to the rotation trade. Here is a daily scoreboard for the rotation trade on Friday. As you can see, they've all underperformed. Specifically, when we talk about the comeback stocks, we talked about the AstraZeneca delay, and of course, the resurgence of the virus in Europe hitting the comeback stocks significantly. However, when we switch to the big picture in the weekly rotation trade scoreboard, you can see a clear outperformance by the comeback stocks. And of course, worthy of mentioning is the performance of Zoom and Peloton, which indicate that the correction has not hit retail traders and investors yet. You see institutions being shaken out of the momentum names that ran really hot, like Apple, Nvidia, Microsoft, Facebook. Peloton and Zoom are not widely held by institutions. They are held by retail traders and investors mostly, and that shows that the correction is not through yet. Retail investors will be hit next. They will panic. And when retail panic, they create significant flushes to the downside in the overall market. And now let's switch to the charts analysis because we do have important things to discuss. Starting with a chart of the SPY, the S&P 500, a daily perspective. You can see that we are now seeing the second leg formation of the bear flag, and the next support in sight is the 323 level. Looking under the hood for a 15 minutes perspective, you can see the 333 support. It acted as support in the beginning of the day, and then when we broke below it, the SPY tried to climb above it again. However, it acted now as a resistance. And when you look at the big picture from a 15 minutes perspective, you can see the formation of the bear flag again. Switching to a weekly perspective of the SPY, you can see that we are now crossing the MACD on the negative territory, and we are making red impressions, signaling that this is the beginning of the correction, not the end. And there are a lot more room to go before we find a bottom and reverse. Of course, this formation in the SPY, combined with the news of the virus in Europe, and what's going on with the technology sector and the outperformance of materials, that tells me that there will be lots of pain coming in the stock market. Therefore, I started buying puts on my long positions to protect myself from the downside. Moving on to a monthly chart now of the SPY. Take a look at the long yellow line, trend line that goes all the way back to 2009. Do you rationally think that we will never touch this trend line again, this very long-term trend line? You bet that we will come down to this line at some point and revisit it and rally again. Whether this is going to happen this time around with a correction or later on next year, who knows? But this is about 26% decline from the top, assuming we reach that destination by February of next year. It is very reasonable. It is very logical correction. Moving on to the chart of the triple Qs, the Nasdaq daily perspective. You see all the support levels we've been identifying before, they've been broken, so they're now out of the picture. The next support we're looking for is in the southern destination 251. If that doesn't hold, we have 237 in and around that area, and that will indicate another 10% decline for the Qs, which will lead us to over 20% decline from the top aka we enter a bear market. And of course, a lot of technical analysts said that we have bounced back in the Qs, we revisited certain levels and we bounced back. I don't buy this crap. I think this is a result of quadruple witching and the max pain theory we discussed on Thursday. Case in point, looking under the hood, 15 minutes perspective, here is how the max pain theory played out. In the beginning of the day, they shook out the calls, they made sure that they got closed and they will expire worthless. And then at the end of the day, the last 2 to 3 hours of the day, they took care of the puts, making sure that the majority of them will expire worthless. And that is, of course, how quadruple witching and the max pain theory in the options market work. Needless to say, of course, from a big perspective, we are forming a bear flag from a 15 minutes perspective as well. And now moving on to the big picture of the Qs, the weekly chart. You can see that we've crossed the MACD, indicating the end of the trend. We destroyed the trend, and now we're making red impressions in the MACD. We just started doing that, again indicating that there is more room for the correction to run. And of course, look at the trend line from all the way to 2016 in the Qs. You think we're not going to visit this line again? Rethink. And that would be, of course, a 40% decline from the top. Very rational, very reasonable. It could happen, and it is on the table. Moving on to the short triple Qs now. Maybe we can see something here that we haven't seen in the Qs chart. Of course, here's a 15 minutes chart, and let me remind you of a tweet I released on September 15th. Indicating that I'm buying the short triple Qs again. Now, I don't need to put a disclaimer for you because you're not a child, that these are not stock buying recommendations and you need to talk to your own financial advisor, blah, blah, blah. We know that. If you're just going to follow me blindly, I guarantee you're going to have some losing trades because not every trade I do ends up being profitable. But this one did, and if you followed me in this trade, you have made over 20% gains. And you can see the bull flag formation, of course, as the short triple Qs started exploding higher. You see one massive leg up, a retreatment and a retraction, gathering more energy and then moving higher again. And you see the pattern happening over and over. We can safely assume that what we have seen on Friday is another continuation of this pattern. The Qs ran high, it retracted the last few hours of the day, gathering more energy before another pop higher this coming week. When does that prediction become scrambled eggs? If we break the 2660 support. Then we can see a different picture of the Qs rebounding and rallying, at least in the short term. Moving on to the chart of the VIX, here is a daily perspective. The VIX has been very frustrating lately because you've seen all the rout in the market and the red days, yet the VIX is not doing anything, is very muted, trading in the red sometimes. According to the VIX futures, we will hit the 30 level at least by October, meaning that there is more upside to the VIX. And from my perspective, the muted action in the VIX the last few days were an opportunity for you to accumulate positions, bullish positions in the VIX. That is at least my 2 cents. And moving on to the dollar index, here is a weekly chart of the dollar. You can see the MACD, the weekly MACD of the dollar is ready to cross the average to the upside and create green impressions, meaning further upside for the dollar, which will coincide with a big, massive, panicky market correction, where you will see the typical attributes of a correction. The dollar spiking higher, treasury yields going lower. Again, the long-term picture of the dollar is negative. But in the short term, the dollar can rally hand in hand with a big panicky market correction. Now you see that we're piecing the pieces of the puzzle together, that we are heading to a massive market correction. And we have seen so far is just a teaser, the appetizer before the entry course is served. And it's not gonna taste delicious if you're long the market. Of course, it is worthy to visit the 2005 case in the dollar. This is of course a coincidence with the Maestro Greenspan in 2005. You can read what happened back then. The dollar was on a downtrend, yet it spiked significantly, as you can see from the chart, before cooling off and resuming the downtrend later. I see the same thing happening in our case here in 2020. Moving on to two important charts, Apple and Tesla. Two names that will shape the destination of the market. Starting with Apple, a weekly chart, you can see that we crossed the MACD to the negative territory, indicating the beginning of the decline, the beginning of the correction. And of course, I released a tweet saying if we break the 106 level in Apple, we will start a domino effect decline to the southern destination. Given the weighting of Apple, a breakage below 106 will mean pain for the market overall. And you've seen on Friday, we have held the 106 support for now. Keyword for now. Lastly, take a look at the RSI, and if you are been a follower of mine, you know that I've indicated the level of RSI where I thought Apple shares will top and the level that I will be shorting at. And you see that that level worked to the penny. It couldn't be more perfect than this. Moving on to Tesla stock. Here's the chart, the daily chart. You can see a wedge formation. We have talked about a bear channel, but I think that is too early to draw right now. What we have on our hand is a wedge-ish formation. You see that Tesla stopped more than twice in the upper limit of the wedge. The wedge is indicating indecisiveness. It could break up, it could break down, but again, battery day could create some excitement, yet if the market sells off, Tesla shares will get hit as well. Looking at a 15 minutes perspective, you can see the big fat flush at the end of the day in Tesla. What happened there? I'll tell you exactly what happened. Maximum pain. The largest open interest for the week ended September 18th for Tesla shares were for the 450 strike. Option riders made sure that Tesla shares will not close over 450. This is done by design to make sure that all of your 450 call options either expire worthless or you're gonna close them at a loss. And that leads us to the most important point and the conclusion of the video. We know that what determines the market's outlook here for this week is Tesla's battery day mania. The cult followers of Tesla are waiting for the revelations from Reverend Elon Musk, who's gonna take the stage on Tuesday. You have to keep in mind that options riders are now sitting on a mountain of shares of Tesla. They have bought the stock. Most options, call options, were either closed or not exercised because they've expired worthless. That leaves plenty of unallocated shares in the hands of options riders, meaning that the scale of power is not on the side of the Tesla cult followers. It is on the side of the holders of Tesla shares right now who sold lots of call options the last month. It is in their hand whether they're gonna let the ride higher after battery day or whether they're gonna start dumping their shares. They've made enough profits and that will create a tsunami of selling in Tesla shares like you have never seen before. Add to that, of course, the mania of the Robin Hoodiots now buying the Ultra Pro leverage ETF, the TQQQ, instead of the actual triple Qs, because some TikTokers told them that they can make 3 times the profit if they buy the TQQQs instead of the actual Qs. If this is not an indication of the end of the mania, I don't know what else will convince you. Furthermore, you can see that the put to call ratio is just starting to spike up. It's been the lowest in 15 years and it's just starting to build up. When you switch that to the put to call ratios, specifically for single equities, you can see that the put-to-call ratio reached all-times low, and it's just starting to curl back up and move, meaning that the correction has just started, and there is more pain, significant pain, that will come to the market very soon.
If you found the information presented in this video helpful,
please subscribe, press the like button, the notification button, and follow me on social media.